The discussion today is order flow and live price action. And you probably heard and seen and witnessed a great deal of things this week that were hopefully inspiring to you and encouraging, and hopefully also communicating that there is no noise or randomness in price action, even on a 1 minute chart. And that way it'll help you grow familiar with order flow without any other assistance, no other kind of gimmick that is used in trading, depth of market, ladders, and volume profile, all those things. There is no necessity to use those tools. So when you see me dress my chart up and put what I call as lipstick on it, it may be simply a rectangle as a visual aid, or I'll put little line segments in there, basically drawing reference to a liquidity pool above an old high, below an old low, or like a fair value gap or volume imbalance, something to that effect. In speculation, you're going to be met with a lot of psychological and emotional barriers. And by me sitting with you, showing you every individual candle painting, explaining what I would like to see, what I don't want to see, and then being met with the reality of what the market's actually going to do, it helps you frame a mindset. And that mindset needs to be guarded. That means your attention needs to be guarded. Watching me outline and give commentary over top of live data. I covered the new week opening gap for a couple weeks now. My private students have known this. We've talked about this as kind of like a charter level education. And they, as charter members, they're learning equally just like you are. I'm expounding on something that I introduced to them. And now you're seeing the fruits of understanding what that is and what it can bring to you in terms of knowing what price is likely to do next with a great deal of probability. And what is that? I mentioned that the new week opening gap, which is the closing price of Friday, the previous Friday, and the opening price on Sunday, that range, whichever higher, Friday's close or Sunday's opening, and the midpoint, which is consequent encroachment. You want to extend those levels through the entirety of the week. Now, here's another factor. You want to use that same opening range for every week that starts in that same month. The algorithm will refer back to that within the same month. Now, there's a little bit of an overlap too. What happens if you're using, for instance, like we're in the first and second week of February? Are we just using 2? No, you go back as much as 4 weeks because there's going to be rotation that the algorithm is going to refer back to. It's not always looking at the calendar dates like we would look at, like when January closes. Stop right now. If you're not writing this stuff down, you're wasting your time. You're not going to remember it. You will not remember it. So make sure you have something to write with and record what I'm saying. But you're having basically a rolling 4-week look back. It will, by default, encapsulate a monthly rotation in order flow that the algorithm will refer back to. What I mean by that, the new week opening gap, starting like this week coming here, when we see the opening price on Sunday, we are looking back the last 4 weeks. So there's going to be 4 weeks of new week opening gaps on a chart. You want to save a profile or a workspace or whatever else you would call it on a platform that's outside of TradingView. Whatever that medium is that you save your charts on, you want to set up a template that is for new week opening gaps. And you want to have the last 4. Now, obviously, you'll have a 5th because you're starting with a new week. So right away, you're probably thinking, oh, this is going to be a lot of stuff on my chart. It's actually not. It's actually not at all. So it gives you a X-ray view of how the algorithm will refer back to old areas of real fair value. That's not to diminish fair value gaps, because Fair value is an evolving factor and principle in order flow. Now, when I say order flow, I am not referring to some kind of look inside the candlestick. If you're using this kind of chart, you're an idiot because I used to work at Berkeley's or Barclays or whatever it is. You've seen that guy on there on YouTube. He's always on my videos now. His ads are running on my stuff. But you don't need to have volume or the number of contracts recorded or shown inside of every individual candle. That's irrelevant. You don't need to know that. That is not necessary. But if you want to subscribe to that and believe that fairy tale that that's something's going to help you, you're welcome to do that. Go right ahead. But that is absolute bullshit. You don't need anything like that at all. You're looking for levels of premium to discount, time-oriented concepts and entry points and targets, inefficiency in price, and liquidity. Now, you can also create a template for your new day opening gaps. And what is that? That is the difference between the 5 p.m. closing price on the S&P. This is also for Dow futures and NASDAQ futures and any index really that closes between 5 o'clock and reopens at 6 p.m. Eastern time. So the distinction for new day opening gap, which is always going to be abbreviated as ND, 5 p.m. closing price and 6 p.m. opening price. That's your new day opening gap, that range. And you want to extend that out. Now, you want to do that for like the week and the week before. That's about as far as, in my opinion, I'm only interested in that. So you're going to have as much as 10 of them on your chart. You don't want anything else on that template, just that. And you will see by having a template like that, and also a template that has the new week opening gaps, where there's nothing else on the chart. Well, you don't want to clutter your charts up like that. You want to be able to see price and time, and also how it reaches into these areas of real fair value. You'll be surprised to see how markets reach back to them, turn, gravitate back to them, turn, go through them, act as support, go through them, come back and act as resistance. You'll see real order flow. And it's really a fascinating study. And I don't want you to just take my word for it. I want you to look at it, study it. When the weekend, go back and see how the market referred back to those price points. When didn't it respect it? When it didn't respect it, was it on the heels of a market report that was high impact or medium impact? All those things are important for you to journal. I like, on the weekend, I'll print one chart out, and it's basically what I just shared with you. So what I do is I refer to that, and then I literally pencil in, not pen, pencil in things that I liked seeing about price action. One or two things that I was expecting that didn't pan out, and anywhere that I would have taken a trade that was wrong. If I get stopped out, if I miss a trade, if it doesn't fill my limit order to get into a move, then I'll write down my observations and my thoughts about it. I don't go in and say, shit, I missed this fucking move. Why did I not do that? Ugh, that's frustration. You don't want to record frustration. You want everything. You want to be writing a love letter to yourself. Every single time you're journaling, you're encouraging that inner trader to come forth. You want to manifest that positive thought, principle-oriented, analyst supported speculator. And you want to stomp the shit out of the gambler that's inside of you that wants to well up all the time and push the button just to see what would happen. So you're constantly balancing all that stuff. But I usually print a 1-minute chart like that because I don't need to have a 15-minute chart. I don't need to see a 5-minute chart because you can see every turning point with that 1-minute chart. But you can also see much more details in the order flow. And I only brought out, in my opinion, some of the salient points, which is also what was making its way into my live streams. So you can see what I was referring to, points of importance to me, and what I felt that was algorithmic for future prognostication, which was told to you real time, either through Twitter or when I was doing the live sessions. For now, I just want to talk a couple principles that you want to have when you go forward, and you've seen me implement them this week in our first, I guess, hands-on over-the-shoulder ICT experience with live streaming and calling the markets. Order flow, by definition, mine, is reading the tape and internalizing how price is being delivered right now. Is it in a buy program? That means it's going to continuously move towards higher prices. And that could be gravitating towards an inefficiency that's above market price, or a liquidity pool above an old high or relative equal highs, or multiple highs. Like we've seen this week, we've seen 4 intraday highs and then ran it and then went lower. Or order flow is referencing and studying price right now, live. If it's in a sell program, where it's continuously pricing lower for a discount, reaching into either a inefficiency, that's either a fair value gap or maybe a volume imbalance, or an actual gap, like a gap at the new day opening or new week opening. So when I taught the PD array matrix in the core content that you can see on my YouTube channel for my private tutorship, the PD array matrix, I gave out a very specific order of where certain PD arrays would usually form in their hierarchy. So the highest form of a premium array to the lowest form before you get to equilibrium, where they rank among themselves in delivery usually. Volume imbalances are not in that PD array matrix. Institutional order flow, entry drills are not really in that either. And new week and new day gaps don't exist in that ranking either, because why? They're variable. There's no static reference point where they're going to form. It always looks like this. No, it's not true. But in a price run from an old high down to an old low, in that range, if you're working your way back up, the PD arrays form exactly like the PD array matrix I gave you in that core content. And you learn that in month 5 content, in case you're wondering where that's at. So just go to the month 5 playlist and go through that, and you'll see all that stuff there. But volume imbalances can occur anywhere in a price run. There's no hierarchy. There's no importance of it forming above or below a fair value gap or a breaker. It literally can form anywhere. And these gaps, because nobody, not even me, nobody knows where a new day is going to open at 6 p.m. No one knows where the market's going to open up on Sunday. So because those are variables in price action and price delivery, you have no idea what they're going to do. You don't know if there's going to be a bomb dropped on some country that's going to cause everybody to wig out and cause all kinds of panic. And that excitement is going to be used. And they'll open the price up extremely far away from the last closing price on Friday. And they will inspire and quote unquote engage and engineer sentiment. So when we're looking at order flow, we're referencing what the retail trader may be expecting in price action based on what books and theory they use, what they're looking for price patterns, like bull flags and head and shoulders and things like that. We don't like those patterns. I am teaching you not to draw any affinity for those things, except for taking advantage of being against that principal idea. When there's a wrestling match between smart money and retail price patterns like that, and harmonic patterns and things like that, they will lose. They will lose every single time if it's against a smart money idea. Now, when that wrestling match begins, you may or may not know at that moment that you should be expecting or anticipating it because you're relatively new. That's the benefit of seeing it over my shoulder. When I'm showing my charts and I'm talking over top of it, I'm giving you that 3 decades and 30 years of experience reading price action. You're seeing it through my eyes, and I'm doing my best, and I may not be effective, as much as I'm hoping to be, as far as articulating what should be happening next and what's going on. But over the year, listening to your feedback and such. I'll use it constructively if it's respectfully given to me. But there's also limitations as far as where I'm going to go and what I'm going to do. So, but real time watching price, and as price is moving up, let's go back to that analogy of we're looking for higher prices. Let's assume for that moment, price is likely to go higher. It's going up to a premium level. It's going to a buy side liquidity pool. It's obvious the market wants to get up there. It just keeps pressing higher, higher, higher. And what we're looking at for order flow is, do every PD array that I would teach you and what you see me reference in real time 1-minute charts, is it providing support? Is it preventing price from going below 3 PD arrays? A buy program where markets are bullish and we're looking for price to continuously deliver. Delivering is constantly booking and printing new higher highs, not higher highs like in thinking like market structure, like you see people teaching market structure, higher highs, higher lows, higher high. Fuck that. That's too simplistic. That is not what I'm teaching you. You don't ever hear me teaching higher high, higher low bullshit. Okay, that's right out of retail books. Stop that. It's understandable and it's introductory. That's great. What I'm talking about is, does each individual candle, when it expands higher, when you're bullish and you're watching that buy program unfold, and it's digging in to higher prices and just keeps printing and creeping up and encroaching on that old high where buy side liquidity pool is resting, where real buy stops are resting. I'm teaching you to look at every individual candle and how it relates to the candles just before it. So it's going to create a small little stair step, and every little candle should support the new one. Every down close candle, I'm looking at that. This is the primary function of how I teach order flow. A bullish market, when the market rallies away and it's reaching to buy side liquidity, I'm watching, does the down close candles support price? That's a primary observation for me. I'm looking at that. By itself, that's going to serve you better than any of the bullshit out there you're looking at. You're looking at level 2 data. You're looking at, ladders and depth of market and volume profile. All that stuff is distracting you from just looking at the candles themselves, because they're going to tell you everything you need to see, and it won't divert or dilute your attention. You're simply looking at, how are the candles relating to one another? Is it continuously giving you constructive feedback that you are on side and expecting higher prices? Now, that's not to say that you won't see a break lower that comes back for a short-term low and takes out a pool of short-term sell stops. That's normal. That's absolutely normal, which is why I teach how you are not to be in a rush to move your stop loss. That's the number one reason why I tell you not to be in a hurry to move that stop loss up. I'm training you to trust and have conviction about where the market's going to go. Your safety net is your stop, but you don't need to have the safety net and training wheels and harnesses all around you because you're going to be too afraid to trade then. You have to step out there and embrace that uncertainty by watching the candles print, and that's essentially booking price. When that higher price is expected, that's gravitating towards that buy stops, every down close candle should support any return back on the new candle or a future candle that would trade down into it. It's going to expand higher and then pull back a little bit, expand higher and pull back a little bit. And the narrative behind what price is doing, you can read that and internalize how all the real order flow is coming in. Focus on what matters most. That means the price right now. And as long as price is moving in the direction that you expect it to go to, down close candles are supporting price. Now they can go through them. When would we expect price to go through them and not freak out? If there's a fair value gap, if there's a short-term low that has recently formed, and we are not in the upper quarter of where the price should go to for target. Let me say that again slowly so that we understand what I'm referring to. If you believe that you have figured out where the low is in the market for this particular price swing, and you think it's going to go up to an old high where buy stops and buy side liquidity is, that midpoint of that run, that will be equilibrium. Now that range is not really there yet. You're just implying that that's where it's going to likely go. So therefore, between where you think the beginning point of that run is, the low, you may or may not actually be in the move yet. But assuming that you are or aren't, who cares? The midpoint of that equilibrium price point, at that point or below it, that's where your best buys are going to occur. But now, as soon as we get to the upper quarter of where that target is, you're going to see less likely retracements to a stop that would be below old lows. Like in other words, the market's not likely to go back for sell stops. Now it can, but largely it doesn't. As soon as you cross the threshold of the opposing side of that discount to premium or premium to discount range, and we're going to use the analogy I'm talking here, we are in a buy program. That means they're expecting higher prices. It's going to go to a premium inefficiency fair value gap or an old high to run out stops. So that's the magnet, that's the draw on liquidity. So as the market goes higher, whether you got in at the low that started that price run or didn't, you got to know exactly where to go back to see the beginning of that move. So that point of inception and where your target is, which is terminus, between those two price points is equilibrium. That's where the difference between discount to premium, that's where it starts and ends. But if you go halfway between equilibrium to your target, which is terminus, that's in premium range, not discount. In other words, think of it like now we're overbought. As soon as we get to the final quarter of the run that gets to the target, as soon as we get into that vicinity in terms of the price run or range of how far it's been moving up, it's less likely to see a stop run below old lows. Why would it be like that? Because it's going to be in a hurry to run out the buy stops because they may catch wind about what's likely to occur. You know what it's like to be short and your stop sitting above an old high, because you know as it's getting closer to your stop, it's likely to do what? Run for it. And that's why the market is less likely, not that it's impossible to do so, but it's less likely for it to come back against you and run sell stops before it runs to your target, because it's going to be in a hurry to reprice, because it doesn't want to give the opportunity for those orders to be pulled, close the trade and collapse and reduce the amount of liquidity for smart money traders. That's why the algorithm's coded that way. It's coded to do that very thing, because right above those highs, it is, once we get to that last quarter of the price run, accelerate. I'm looking for speed. I'm looking for the big range candles expand up and run into that liquidity. Pow! That is a purge of liquidity. Order flow, we're looking at how those candles support one another and how, if there's any retracement, it's only going to retrace down to the nearest fair value gap below price. Well, we're in a buy program and it's moving higher, reaching for buy side liquidity. Or every down close candle will support price. It just means that the market's going to go back and offer fair value to the marketplace, which is going to be identified by you as a smart money trader as a new opportunity to add or enter.